Hello everyone, thanks for checking out my video. Merry Christmas in advance. The US market rose last Friday with the S&P 500 info tech sector posted its biggest rally in nearly a month. The tech rally was lifted by Oracle, Nvidia and Micron as various AI companies regained its footing after experiencing recent pullback and volatility. Signs of cooling inflation and fading AI worries had boosted Wall Street optimism towards the tail end of a choppy week. As we approach the end of the year, the big question many of us have in mind right now is whether this rebound marks the start of a center rally or if the market is setting up a bull trap that could catch investors off guard. There are some interesting statistics that are worth looking at for this period, so do watch till the end of the video. Major US indexes and tech stocks rose last Friday after snapping a recent losing streak as AI trades appeared to get back on track. Several leading AI names including Nvidia, AMD, Palantir, Micron and Oracle all rallied. Large tech names were kind of carrying the market during last Friday's session, and their gains have helped to stabilize a market that was kind of acting a little nervy in the previous 2 weeks due to unease over the massive spending spree on AI infrastructure. The share price of Oracle jumped nearly 7% after TikTok agreed to sell its US operations to a joint venture, which would allow the company to maintain operations in the United States. The deal will see Oracle taking a 15% stake in the joint venture with other private equity funds. Elsewhere, share price of AI chip giant Nvidia popped about 4% on a report that suggested the US is reviewing prospects for sales of its H200 chips in China. Additionally, Micron's share price extended their gains from the previous session, rising around 7%. The stock had earlier surged 10% on Thursday after the company gave robust guidance for revenues in the current quarter, providing reassurance to investors who were worried about AI investments. Investors also got through a catch-up week of economic data with next year's rate cut hopes still intact as the market embraced the outcome of delayed November reports on jobs and consumer inflation. A rosier inflation picture combined with a weakening job market has reignited hopes that the Federal Reserve will continue its recent string of monetary easing. With the late week rebound, the S&P 500 and Nasdaq locked in weekly wins, rising 0.1% and 0.4% respectively, as Wall Street tries for a center rally to end the year. And that brings me to the next segment, Market Outlook. The upcoming week will be a holiday shortened week as the stock market will close earlier on Wednesday, Christmas Eve at 1 p.m. Eastern Time. The market will then close for the entire day on Thursday for the Christmas holiday. Throughout the week, there doesn't appear to be many market-moving catalysts and trading volume is expected to be light, which could suggest the potential for higher volatility. It is going to be difficult or perhaps impossible to forecast which direction the market is likely to move, not only because there were a lot of mixed economic signals last week, but there's also a mixed technical picture. More on that later. Meanwhile, the market could still be feeding off the CPI news last week, though some analysts are skeptical about the inflation numbers we saw. That said, it does look to me that inflation may have peaked, at least for now, and that's good news for the Fed and the stock market. Moving over to the technical analysis segment. Before that, a quick shout out. This is my 4th year running this YouTube channel since I started in December 2021. I know the growth has been slow, but that's okay. But I'm just not sure why my view count has dropped so drastically over the past few weeks. Since it is the season of giving, I would really appreciate if you could like, comment and subscribe. I hope these small actions can help to push the videos to more people out there and to keep this channel going. And if you would like to support even further, you can buy me a coffee via my Ko-Fi link, give a YouTube super thanks, or sign up for a Longbridge brokerage account using my referral link. Alright, back to business. The broader market SPY is trying to recover from its recent short-term pullback. There was one bullish signal based on last week's price action, and that is the bounce of the 50 moving average. Personally, I will use this moving average as a reference point from now till the end of the year. If SPY falls below it, then I think center rally is cancelled. But if SPY continues to stay above it, then there is a chance for center rally to play out. The 50 moving average currently sits at 673. For confirmation of a center rally, watch that MACD closely. If we have a bullish crossover this or next week, then I think there is a high chance that SPY could go above 685 and probably stand a decent chance to create a new all-time high by breaking above 687. Alright, let's have a look at Apple's chart. Apple was looking resilient at one point, which was what I shared in my last video. Not gonna shun away from that. But it is important to stay flexible and have an open mind. Last Monday's big red candle is a warning sign that Apple's share price wasn't going to hold. And so the next thing we knew, Apple fell from 280 to as low as 260's range. Okay, but just like SPY, Apple also bounced off the 50 moving average, which sits at 269. That's a slight positive signal, but we need to observe how the price moves in the next few trading days. If Apple continues to move above the 50 moving average, then that's a good sign. But for Apple to be caught slightly bullish, we need it to close above the 23.6 Fibonacci level at 278 at least. For full-blown bullish momentum, very straightforward, just get above that green uptrend line again. On the other hand, if Apple starts closing below the 50 moving average, then I think we could see Apple testing 266 where the pivotal 50% Fibonacci level is. If somehow by year end, Apple closes below both the 50 moving average and this Fibonacci level, I would say Apple is bearish in the short term. That's when we need to be mentally prepared that Apple could hit sub 260's range. Jumping over to Tesla's charts. Wow, all-time high. Tesla hit record high last week for the first time in 1 year. Let's talk about the straightforward case first, the bullish case. As I have always mentioned, at all-time high is what I like to call the uncharted territory. Usually at this area, it is very difficult to tell when will the share price want to take a break. Because a lot of times, investors and traders would want to let their winners run, which means sellers usually dry up here. And then you somehow will see FOMO investors who didn't buy when the share price was lower starting to come in to buy at all-time high. This pushes the price higher and higher till God knows when. It's kind of a greater fool theory. Okay, before I digress too far, what I'm trying to say is that I wouldn't be surprised to see more record highs in Tesla from now till the end of the year. But don't get me wrong, this is not a prediction and it's not guaranteed. If we don't see further record highs, what should we watch out for? I would say pay special attention to 468. This level, other than being the very first Fibonacci retracement level, it used to be a level of resistance as well, which has now turned into a support. Personally, I think it should act as a decent support. At max, Tesla may temporarily breach this 468 level to fill the gap between 463 and 465 before bouncing up. If that happens, it's pretty bullish. But again, let's not try to predict the price action. Let's say, somehow, this decent support at 468 breaks, I would think the share price has a high probability to continue falling towards the 50 moving average at around 440. Coincidentally, that's also where the pivotal 50% Fibonacci level is, thus forming a double support. Honestly, you won't want this level to break, because if it does, then it could be waterfall time for Tesla. Okay, let's now check out Google's chart. Google has been pulling back, and it is in this mini downtrend with a series of lower highs. This makes the analysis quite straightforward. For Google to reverse this downtrend, it has to first get above the 23.6 Fibonacci level at around 307. Second, go above the blue downtrend line. If Google can do it in the next 2 weeks, then the bearish trend would have been reversed, and there is a chance for the price to test the all-time high at around 328.6. In terms of the bearish thesis, watch the 38.2 Fibonacci level closely, which sits at 293. Other than being a Fibonacci retracement level, coincidentally, it was a level of resistance previously when Google was attempting to break out. This resistance level has since turned into a support level. Since this is a double support level, it should likely hold, but I would like to caution that in the event that it doesn't hold, I do think we could see Google back in the low 280s range, testing the 50% Fibonacci level at 282. Personally, I'm waiting for opportunity to sell the put option on Google. After Google had that gap filled, it seems like it is trying to bounce up. If we can get confirmation of the bounce, then Google does have quite a fair bit of upside potential, and that could present an opportunity for me to step in. Not financial advice, of course. Moving on, we shall have a look at Meta. Meta's chart looks not bad to me. Since it had that little pullback and briefly fell back into the purple downtrend channel, the bull stepped in and pushed the price back up. That's quite positive in my opinion. But at the end of the day, I would focus a lot more attention on the two important 50 and 200 moving averages. As long as Meta is trading near these two moving averages, I think there isn't a clear trend yet. I mean, it can be leaning bullish now, but the moment it gets rejected by the moving averages and fall back down into the purple channel, it is bearish again. In short, we need a clear break away from the two moving averages to get a clearer picture of where the share price is headed. But if I were to choose a side, my view is that the chart is swinging towards the bullish camp a little. That being said, again, stay flexible because things might change overnight or over a couple of days. Oh, just one more thing to add. If Meta can close above 675, which looks like a resistance level to me, that could be a signal to tell us that the momentum is bullish and that could be more upside. Let's now hop over to Microsoft. Microsoft's chart looks a little tricky. The short-term trend is neutral because it has been moving sideways since 19 November. That's one full month of consolidation. But the micro short-term trend is swaying bullish a little bit because of how it bounced off the 200 moving average last week. Okay, that being said, I would caution calling it bullish yet because it is struggling to break above the resistance level of around 493. Until I see Microsoft starts closing above this 493 level for a few days, I really wouldn't say that the trend is bullish. Let's say if Microsoft does that between now and the year end, I'm actually expecting Microsoft to grind towards the 50 moving average at 499, as well as the small gap between 502 and 504. So yup, watch for the 493 level if you are on the bull scam. On the other hand, if you are a bear, then your attention will be on the 200 moving average, which now sits at around 472. Microsoft has bounced off this moving average on 2 occasions in the past 1 month, so if it tests it again, it will be interesting to see how the share price reacts to it. Will third time be a charm? Let's see. Okay, and if Microsoft does break below the 200 moving average, then watch for 464-465 level. That's the recent low. Going below this level would mean the bears are in control, and we probably can expect to see further more downside towards the 450s range or even 440s. Last but not the least, let's check out Nvidia. Nvidia seems to have found a pretty strong support at this low 170s range, marked by that green rectangular box. The share price has bounced off this area multiple times in the past, which includes last week. But will I say Nvidia is bullish? Not really. It actually looks neutral to me. First of all, yes, bouncing off that support zone is positive, but then we still have two heavy resistance levels at the top, namely that blue line and the 50 moving average. These levels are 185 and 186 respectively. We will need to see a few solid candles closing above these two levels, then we can say that Nvidia's short-term trend is bullish. Otherwise, to me, it is just sideways movement or what we call consolidation. On the other hand, with the green box being drawn out, it makes the bearish thesis straightforward. If Nvidia closes below that green support zone, things are getting bearish, as simple as that. That is the time where I think there is some probability that Nvidia will test the recent low of 164. And that level to me is kind of like a last line of defense, which means if it breaks, it's waterfall time for Nvidia. Okay, moving on, let's check out my options trade. 6 trades to update this week, with 3 of them being new ones. I shall combine the first 2 new trades together as they are both cash secured put on Nvidia. Both contracts were sold on 17 December but with 2 different strike prices, 155 and 150. Their expiration dates are different too, on 16 and 23rd January 2026. Typically, such a sharp decline without fundamental issues tends to reverse quickly. Coupled with the bullish seasonal trend in December, I believe Nvidia was likely to recover in the coming weeks, so I decided it was the right time to step in. To give myself a buffer, I chose strike prices in the 150s range, since I think the chances of Nvidia falling below 160 over the next few weeks are quite low. And look at the chart now, Nvidia bounced back over 5% in just 2 days. These trades are already up around 54% and 70% in only 2 days. The next trade to update is this new cash secure put on Microsoft. The contract was sold on 19 December last Friday and the strike price is $4.40. This put option will expire on 30th January 2026. The reason for selling this option is straightforward. Microsoft recently bounced off the 200 moving average again, and it is heading towards the resistance level at around 493, which is a small bullish signal. Even if Microsoft gets rejected at the resistance level again, I think it will not be an easy task for the bears to push the share price below the 200 moving average. In addition, the strike price that I chose, $4.40, is actually a decent support level by itself. So long story short, I think the odds of Microsoft closing below $4.40 by end January is not very high. Alright, I will group the last 3 trades together. They are all cash secure puts that expired worthless last Friday, 19 December. The total profit from these trades is close to $600, which is over 750 Singapore dollars. Really not bad for some extra Christmas income. A cloudy economic outlook along with AI-related concerns have weighed on tech shares at the start of December. However, sentiment has improved towards the end of last week, with some investors now pinning their hopes on fresh record highs driven by a possible end-of-year Santa rally. So here's the million-dollar question. Will the Santa Claus rally happen this year? Well, nobody can say for sure, but seasonal factors are looking bullish for stocks. First of all, December as a whole has traditionally been one of the stronger months for the stock market. On average, both the S&P 500 and Nasdaq have posted gains of more than 1% during December. Looking more closely, data from Citadel Securities shows that since 1928, the S&P 500 has risen about 75% of the time during the last 2 weeks of December, with an average gain of roughly 1.3%. As for the Santa rally itself, it typically refers to the period covering the last 5 trading days of the year and the first 2 trading days of the new year. For this year, that would be from the opening bell on 24th December until the second trading day of 2026, or 5th Jan to be exact. And since 1950, the S&P 500 has also delivered an average gain of around 1.3% during this 7-day Santa rally window. In short, history appears to be on our side, whether you look at December as a whole, the final 2 weeks of the year, or the Santa rally period specifically. It is also worth noting that the choppy start to the month and the mid-December dip we have seen so far are actually quite typical for December. In that sense, recent price action is broadly in line with historical patterns and could be setting the stage for a potential Santa rally. That said, this does not mean you should go all in on investing or trading during this period. Statistics are just probabilities. They don't predict the future and sometimes they simply don't play out. Just to add, trading volumes also tend to be lighter towards the year end, which can lead to higher volatility. If you are a newer trader, it may be wiser to sit this one out and enjoy the festive season with your loved ones. For long-term investors, the best and evergreen approach is to stay disciplined and stick to your original investment plan. With that, I would like to wish everyone a Merry Christmas. I hope I can continue producing these weekly market updates in 2026. Honestly, I'm not sure why my video views have been dropping so drastically. So if you can, please like, comment and subscribe to help boost the YouTube algorithm. Thank you.